A spectacle of speculation, the dot-com bubble bursts. The dot-com bubble was a time of incredible exuberance. The internet was new and it promised to revolutionize the way we live and work. Investors were pouring money into internet companies, driven by the belief that these companies would be the next big thing. Many of these companies had no clear path to profitability. They were burning through cash with little to show for it. The AOL-Time Warner merger in 2000 became a symbol of this excess. It was a deal that epitomized the irrational exuberance of the time. AOL, an internet darling, merged with a traditional media giant. The merger was seen as a perfect marriage of old and new media. The deal was valued at a staggering $350 billion. It was a bet on the future of the internet. It was one of the largest mergers in history, and it was expected to create a media powerhouse that would dominate the internet age. The merger was supposed to create a media powerhouse. It was expected to dominate the internet age and set the stage for a new era of digital media. It was expected to dominate the internet age. The combined company was supposed to leverage the strengths of both partners to create a new kind of media company. However, the merger was a disaster. The promised synergies never materialized, and the company struggled to integrate its operations. AOL's dial-up business struggled to compete with broadband. The internet was evolving, and AOL was being left behind. The promised synergies never materialized. The company was unable to deliver on the grand promises that had been made. The dot-com bubble burst soon after the merger. The stock market crashed, and the value of internet companies plummeted. AOL-Time Warner's stock plummeted. The company was forced to write off billions of dollars in losses. The company wrote off billions of dollars. The merger that was supposed to create a media powerhouse ended up being one of the biggest failures in corporate history. The dot-com crash had a profound impact on the tech industry. Countless companies went bankrupt. The dreams of many entrepreneurs were shattered. Millions of dollars were lost. Investors who had poured money into internet companies saw their investments evaporate. The crash served as a cautionary tale. It highlighted the dangers of speculation and the importance of sound business fundamentals. It highlighted the dangers of speculation and hype. The dot-com bubble was a stark reminder that not all that glitters is gold. It showed the importance of sound business fundamentals. Companies need to have a clear path to profitability and a sustainable business model. The crash also paved the way for a new era of innovation. The lessons learned from the dot-com bubble helped shape the next generation of tech companies. The bursting of the dot-com bubble marked the end of an era. It was a time of both excess and innovation, a period that will be remembered for its highs and lows. It was a time of both excess and innovation. The dot-com bubble was a period of great promise and great disappointment. The lessons learned from the crash continue to shape the tech industry today. The dot-com bubble taught us the importance of caution and due diligence. It reminds us that even in the face of rapid technological advancement, sound business practices and a focus on real-world value are essential for long-term success. The dot-com bubble may have burst, but its lessons continue to resonate. Echoes of exuberance, parallels in the AI boom. Today, the rapid rise of artificial intelligence has sparked a new wave of excitement and investment. The buzz around AI is palpable, with tech conferences, media outlets, and boardrooms all abuzz with discussions about its potential. Just as the internet was the transformative technology of the dot-com era, AI is seen as the driving force behind the next technological revolution. The promise of AI to change industries from healthcare to transportation is reminiscent of the early days of the internet. This has led to a surge in funding for AI startups. Venture capitalists are pouring billions into AI ventures, hoping to find the next big breakthrough. Investors are eager to get in on the ground floor of what they believe will be a multi-trillion-dollar industry. The allure of potentially massive returns is driving a frenzy of investment activity. The parallels between the dot-com bubble and the current AI boom are striking. Both periods are marked by a rush to invest in the latest technological advancements, often without fully understanding the long-term implications. Both eras have been characterized by a similar fervor and speculative frenzy. The excitement is palpable, with investors and entrepreneurs alike caught up in the possibilities. Investors are pouring money into companies with unproven business models. Many of these startups are still in the conceptual phase, with little more than a promising idea and a pitch deck. Valuations are skyrocketing, often based on future potential rather than current performance. This speculative investment is driving up the market value of AI companies to unprecedented levels. This exuberance is reminiscent of the dot-com era, when companies with little more than a website and a dream were able to attract millions in funding. The parallels are clear, with history seemingly repeating itself. However, just as the dot-com bubble eventually burst, there are growing concerns that the AI industry may be headed for a similar fate. The fear is that the current enthusiasm may be unsustainable in the long run. While AI holds immense potential to revolutionize various sectors, many companies are still in their early stages of development. The technology is promising, but it is still evolving and maturing. Their products and services have yet to be widely adopted or proven profitable. The gap between innovation and market readiness is a significant challenge. This disconnect between hype and reality has led some analysts to warn of an AI bubble. The cautionary tales from the dot-com era serve as a reminder of the risks associated with speculative investment. Red flags on the horizon. Early warnings from the dot-com era. During the dot-com boom, there were numerous warning signs that the market was becoming overheated. Experienced investors and analysts cautioned against the unsustainable valuations and speculative investments. However, their warnings were largely ignored amidst the euphoria. One of the most prominent red flags was the proliferation of companies with no clear path to profitability. Many of these companies were simply burning through venture capital, hoping to achieve rapid growth and market share before figuring out a sustainable business model. Another warning sign was the rise of questionable accounting practices. Some companies were inflating their revenue figures or hiding losses to make their businesses appear more attractive to investors. This lack of transparency further fueled the speculative bubble, as investors were making decisions based on flawed or misleading information. The collapse of Enron, WorldCom, and other high-profile companies in the early 2000s exposed the widespread accounting scandals that had plagued the market. The dot-com era also saw a surge in mergers and acquisitions, often driven by a desire to consolidate market share or acquire promising startups. While some mergers can be beneficial, many during this period were ill-conceived and ultimately destroyed value. The AOL-Time Warner merger is a prime example of a mega merger that failed to deliver on its promises. Section 4. The slow deflation. A gradual decline into reality. The bursting of the dot-com bubble was not a single catastrophic event, but rather a gradual deflation that played out over several years. It was a period marked by a slow and painful realization that the exuberance of the late 1990s was unsustainable. The Nasdaq Composite Index, which was heavily weighted towards technology stocks, peaked in March 2000 at a value of over 5,000 points. This peak was the result of rampant speculation and the belief that the internet would revolutionize every aspect of life and business. Over the next 2.5 years, the index experienced a steady decline, bottoming out in October 2002 at just over 1,100 points. This prolonged downturn reflected the market's slow adjustment to the reality that many tech companies were not as profitable as once thought. This decline wiped out trillions of dollars in market value and led to the bankruptcy of countless internet companies. Many startups that had once been the darlings of Wall Street found themselves unable to sustain their operations. The dot-com crash was fueled by a number of factors, including rising interest rates, slowing economic growth, and a realization that many internet companies were overvalued. Investors began to scrutinize business models more closely, and the hype that had driven stock prices to astronomical levels began to fade. As investors began to lose confidence in the tech sector, they started selling their holdings, driving down stock prices. The initial sell-off triggered a wave of panic, leading to a broader market decline. This created a downward spiral, as falling stock prices led to further selling pressure. The more the prices dropped, the more investors wanted to get out, exacerbating the decline. The crash had a ripple effect throughout the economy, leading to job losses, reduced consumer spending, and a general sense of uncertainty. Entire sectors were affected, and the optimism of the late 1990s was replaced by a more cautious and conservative approach to business and investment. While the bursting of the dot-com bubble was a painful experience for many investors, It also served as a necessary correction that cleared out the excesses of the market. It forced a re-evaluation of what constituted a viable business model and led to a more sustainable approach to growth. The crash forced companies to focus on profitability and sustainability rather than simply chasing growth at all costs. This shift in focus laid the groundwork for the more robust and resilient tech industry that we see today, where innovation is balanced with practical business considerations. Section 5, Picking Up the Pieces, Innovation in the Aftermath. The bursting of the dot-com bubble, while a period of significant financial loss and market correction, ironically paved the way for a new wave of innovation. The crash weeded out the unsustainable business models and speculative ventures. This created space for companies with strong fundamentals and innovative ideas to thrive. The availability of skilled labor, coupled with lower operating costs, allowed startups to emerge with greater efficiency and agility. The post-bubble era saw the rise of companies like Google and Amazon. These companies capitalized on the infrastructure and technological advancements of the dot-com boom. They focused on developing innovative products and services that addressed real-world needs. Google's search engine and Amazon's e-commerce platform revolutionized how we access information and shop.